Hi, I'm James Robinson. I manage money for a living, and this is my stock pick of the week. This is part 3 in my 5-part series on the company EXPD, Expiditors International of Washington. Today we're going to look at the company's balance sheet. Most people don't seem to want to watch these videos, and I can't figure out why. The fact is that if you're not aware of the amount of debt your company has and the amount of interest payment obligations they have, then you don't really know very much about your company, and you shouldn't be buying that stock. A company can get in real trouble if it has a ton of debt, especially when interest rates are going from 3% to 5 or 6 or 7%. So the balance sheet allows me to look at what the company is doing in terms of its risk management. But there's more that we can tell from the company's balance sheet than just how much debt they have. One of the things we can tell is over time, are they needing debt to continue to fund their operations? I would argue great companies don't need debt to fund operations. They should be able to do that from their operating capital, from their profits. So let's take a look with EXPD at the balance sheet. So the first thing we want to do is look at cash and marketable securities. You can see this company went in 2001 and had about, call it $200 million in cash. Today they have, 20 years later, about $1.4 billion in cash. That's a 7-fold increase in cash over 20 years. More importantly, they've gone from about $800 billion to about $1.6 billion in the last 7 years. And they've done that while paying dividends and while buying back stock. So that's a fantastic evidence that this company is doing a great job, and they have cash on hand to do acquisitions or to utilize for corporate purposes, or I believe to pay a ever-increasing dividend to the shareholders. So the cash and marketable securities for this company shows the company seems to be in good stead. Before I continue on, 3 real quick points that I'd like to make. I love to know where my subscribers are. It gives me I think it's very cool when I find out I've got a subscriber from some country from all around the world. So do me a favor, in the comments, just drop down and write a quick note saying, hey, I'm writing you from, Brisbane, Australia, or, Hangzhou, China, wherever you're from, I'd love to hear about it. Also, if you want more information on stocks, articles that I find interesting, etc., follow me on Twitter at Robinson Stocks. And like every other YouTuber, I'd love it if you'd subscribe and hit that notification bell so you could see when I post new videos. The next thing I look at is current assets, and I compare them to current liabilities. So just some accounting terms. Current assets are assets that you either currently have in your possession or that you will have in your possession in the next year. Typically receivables is an example of that. You don't yet have the receivables, but you're owed money that you expect to collect in the next year. Current liabilities, on the other hand, is money that you either owe or will owe in the next year. And so what I like to see is that there's a constant, safe buffer between those two numbers, that the company isn't running such a tight ship that if something goes wrong with one of the receivables, they might not have enough money to make payroll or meet their obligations. So you can see at this company that the current liabilities have gone up, but gone up very gradually, especially in relation to profits. But current assets have gone up faster. So that's a good sign. That means this company's getting safer and safer. It also means the company is likely to start to increase its dividends faster and faster, because at some point the company has so much money in current assets they just can't justify it. And hopefully at that point they start giving money back to the shareholders. So I would argue with a company that has $1.2 billion in current liabilities and almost $1 billion more than that in cash, that's a company that could be giving us more and more money back, either through dividends or through buying back shares. So the current ratio is the relationship between current assets and current liabilities. You can see that the top 10% of companies have a current ratio of 4. I think that's way too high. If a company had that big a ratio, I'd be looking for the company to really give us back some money. This company is in the middle of the pack. It's a very safe and sensible number. It's not too high, it's not too low. It's also been very, very constant, really, for 20 years, which shows that the management is comfortable that this is the right number. And I think that you won't see them dramatically increasing this number, which means they should continue to give money back to the shareholders. So here we look at the company's debt analysis. There's 2 kinds of debt. Long-term debt, that's debt that you're going to owe more than a year. You have to pay that back in some period of time that is more than a year from today. And again, current liabilities is debt that you have to pay back in the next 12 months. I am never bothered when I see current liabilities going up. That's a cost of growing your business. An example of current liabilities, for example, is payroll and rent on your facilities. And in theory, as your company grows, or rent on equipment, and in theory, as a company grows, the amount of liabilities that they're going to have is going to also increase. What I'd like to see is that current liabilities are growing slower than profits. But if they're going up, that doesn't bother me at all. The only thing that bothers me is current liabilities are getting ahead of current assets. On the other hand, the company's debt, this company's had no debt since 2000. That's spectacular. Just in the last couple of years, they took on $200 million worth of debt. I'm not sure if that's related to COVID. It could be, or some other number. Again, I could take the time to research that, but it's so small relative to the size of this company. It's a $14 billion company. $250 million is, it's almost a rounding error, and I just am not going to invest the time to figure out that number. Now, if that number continues to increase, it would be something that would cause me concern, but I suspect this company will pay this off over the next 2 or 3 years as they recover from COVID and the economy normalizes. So that's really what I see in debt analysis. And again, when I see the company with no debt, that's a very, very strong sign for me. And that's a company I'm very interested in because it shows me that they can run their operations, they can grow their business, they can grow their profits, and they can do it without needing to run to a bank, which means their operations are more than covering it. That to me is a really, really strong sign of a company I'm interested in buying. Here you can see the company's interest expense, and that's not per share, that's total interest expense. And obviously that chart looks very scary when you see it go, wow, the interest expense between 2005 and 2014 just exploded. But look closer, you realize they're paying less than $1 million in interest, which in a company of $14 billion is, completely irrelevant. How that may be credit card debt for the company, for their employees' credit cards to buy lunches and travel. It's simply a non-issue. It's just that there is an interest expense there, but in terms of scale, it's irrelevant. The more interesting thing is the next slide, which shows interest expense, and you can see that big jagged line doesn't look as big in this context, but the red line is interest income. And so you can see that they've got $22 million between $20 and $22 million of interest income and less than $1 million worth of debt. So the interest income is many, many times the interest expense. That's a fantastic sign. And again, that's the result of having, all that $1.5 billion in cash on market securities. So those securities are going to throw off some profits. So again, interest payments, interest expense for this company, completely irrelevant. It's a really, really good sign. But when a company has no debt, you're going to see numbers like this. This chart is almost laughable. Interest coverage ratio is the amount of times that the company's income can pay its interest. And, in 2007, this company had 10,000 times or 12,000 times the income they needed to pay the company's interest expense. So it's laughable. And since 2012, the company's had no interest expense, so there's nothing to show here. This is the kind of chart that you look at when you're buying a company that has debt and that you kind of chuckle at when a company has no debt. And it's one of those things that makes you very comfortable that interest isn't going to be the thing that kills this company. Debt service isn't going to kill this company. In fact, it's going to allow it to outcompete all of its competitors. When you see a company with significant amounts of debt, it's sometimes hard to put that debt in context. If Apple has, $400 billion in debt, you go, is that a lot or is that a little? Well, one way to look at debt is how many years income would it take to pay off the debt? Now, again, for this company, it's measured in months. It would take a few months to pay off the debt. It's simply irrelevant. But this is a chart that I use when I'm looking at companies that do have some debt so I can get some context of how long it would take to pay off debt. I like companies that take about 4 years or less to pay off debt. I'd still consider a company that are 10 years of income to pay off a debt, but I need to have a really, really good story to make me do that. So again, these balance sheet videos aren't as good when a company doesn't have a lot of debt because there's not a lot to talk about. But the fact is, I want to remind you, as an investor, we want companies where there's not a lot to talk about. We want companies where we can buy the company and forget it and just let it make us money for years and years and years without doing any work. And one of the ways that a company is prone to do that is if it has no debt. So that's the year's income to pay off long-term debt. Interest expense as a percentage of operating income is another way of trying to get your hand around how big a problem the interest payments are. If a company has a ton of interest expense and very little income to cover that, then that's how companies get in trouble and that's how bankruptcies happen. And one of the really important things to think about is if you have a company that has a very low margin here of interest expense to operating income, what's going to happen when interest rates have gone from 3 or 4% to 7% when this company has to refinance its debt and is subject to those new interest rates? So again, I avoid those problems by avoiding companies with a lot of debt. A lot of investors don't. That's one of the reasons why I think 5 or 7% of the companies I look at are worth buying. And hopefully that's one of the reasons why I'm able to outperform the market sort of year in and year out. Again, another way to look at debt and put it in context is look at debt to equity. This company has virtually no debt, and so it's spectacular in this category. Its debt is less than 1 times, much less than 1 times its equity. Fantastic, top 10% of companies. Enough said.